Welcome. You're watching Financial Planner, and today we're in conversation with Feroze Azeez. It's been a few days. We are in Samvat 2075, and it's, of course, the festive season has come to an end. It's been a rough 1 year. Feroze, if I have to compare how things have changed between last Diwali and this Diwali, it's obvious for all of us to see that the financial markets have had it very, very rough and volatile. Investor sentiment has taken a hit. Equity markets have declined substantially. The rupee has fallen quite sharply as well, and global uncertainty has taken center stage. How have things changed, in your opinion, in the last 1 year?
I think, Samina, of course, things have changed in the last 1 year. 1 year is a long period. I think there are some landmark changes, but when it comes to the headline indices, there has hardly been any movement from a 1 year perspective. So 1 year return on the large stocks has been negligible. Of course, mid caps are marginally negative. But if you look at one large change I would like to highlight, or I think one thing which has a long-term impact is the capital gain reintroduction which happened between the two Diwalis. The second thing is, of course, capital was infused into these PSU banks, which was another major thing. From a regulatory perspective, the platform, which is the mutual fund platform, which grew leaps and bounds in that 1 year as well, had a far tighter regulation. Then lately we had this ILFS issue and some degree of scare on NBFCs being able to repay the money and having solvency issues. So I think these are the four major things which happened between Diwalis, and I think all of them have had some degree of impact, not just on sentiment sometimes, but in the long term. And the next thing is we are one Diwali closer, 1 year closer to the general election, which is, of course, to my mind, a reasonably important event.
Feroze, we'll talk about the implications of these announcements in terms of what they've done to financial markets and hence to returns of investors. But let's take a step back. A year ago, we were sounding a lot more optimistic with regard to where the equity markets were headed. It was not just to do with your veteran investor or a veteran trader, but a lot of new and fresh money had started flowing back into equity markets, largely because the regulator making, and of course, companies like yourself making such an effort to go out there and educate people and encourage them to start financial savings. Returns have been not just disappointing, but they've been far worse than what a first-time investor would like. I'm assuming a lot of these people who've been new investors are already put off in terms of their returns. How has the returns played out? I know there's been a pickup in mutual fund inflows in October, but up until then, things were looking difficult, right, with regard to returns?
See, I think return, fortunately or unfortunately, all assets have disappointed. Okay, it's not that some assets have done significantly well, but the whole point is the major assets which contribute to a person's portfolio or his large portion of savings, which is real estate and equity, both haven't done well for that period. In fact, real estate has done worse off, and unfortunately the stable portion, which is called the debt portion, at least from a capital market perspective, that's the safe haven supposedly, and the safe haven from a physical asset perspective is gold. I think debt has disappointed both on interest rate risk, because interest rates went up, bond prices went down, point one. Point two is that the other risk which debt carries is the solvency risk, that the person whose bond you're buying, or the company's bond you're buying, the company doesn't exist to repay the money or is not capable to give your money. So I think debt has been a surprise and a shocker more than equity, because equity always has this attribute to run ahead of times, like it did in 2017. Large portion of 2017 was Nifty going ahead of time, and corporate earnings still lagging behind, and I think it exaggerated its movement and on both sides. So one thing which I would be very disappointed is the debt side, because equity had already displayed for years this capability or a characteristic to not give you a linear kind of a return. So disappointment is more on the debt side than equity, to my mind. And of course, there's a huge disappointment in my mind with respect to corporate earnings and their estimates analyst estimates not sticking, which is a very common sight. Nifty earnings ending at 500 this year is what now becomes the more likely number from 550.
Feroze, let's take this one at a time. And I want to talk about equities before we talk a little bit more detail about debt markets. October managed to clock in record inflows into mutual funds. Again, this is so contradictory to the kind of sentiment that we've seen playing out on the street in the last 6 to 8 months. Are equity markets in India looking attractive right now? What is it that you're telling your clients to do? Because I'm sure there are a lot of those nerves that you've soothed in the last few months.
So on the equity side, I think equity markets are attractive. Not on the Nifty, maybe not on the Sensex, but there is collateral damage which has happened on several good stocks, which you buy direct sometimes, but you use a mutual fund platform so that you're buying a reasonably good value at the price you're paying. So point one I'm making is, of course, equities is a good time. And I think the prospects of equity over the next 2, 3, 4 years is very, very good. Point one. Reason being that equity is a very diverse asset class, and that diverse asset class has a very divergent performance. There could be a stock which is halved, there could be a stock which is doubled, but they're still called equity. So if you are careful in not going into stocks and chasing momentum, I think this is one of the best times to use a value strategy, because there is value. But in a market which was 2017, only a growth strategy could have actually bought stocks, because there was no value in any corner of the market. So to answer your pointed question, is equity a good asset from a 3-year perspective? The answer is yes. Point two is that equity is too big a universe. Value strategy is definitely something which is meritorious in my mind.
Feroze, the jack in the pack is going to be elections. I mean, of course, from the start of next year, things are going to get very busy. There might even be changes in the election schedules. Things may get preponed too. How much of this uncertainty are you pricing in when you talk about looking at equities from a 3-year perspective, and when, of course, you go out and talk to clients about expected returns?
See, when it comes to general elections, if we analyze the last 7 general elections over the last few decades, it's clear. Point one in general elections is you have to categorize the general election. Is it a major event? The answer is yes, Samina. Second is, if you want to understand the impact of the general elections, you have to see whether the possibility of this general election giving you dramatic outcomes, does it be there or not? In my opinion, this general election is going to not have very, very dramatic output. It is going to have a predicted output. It is not going to be from one end to the other end of the spectrum, to my mind. It's about how much of majority for one of the groups is what I think is the debate. It's not a very critical election from that standpoint, relative to the rest of them, of course. Point three is, I think corporate earnings in the last 5-year term. So if you have to understand the impact of general elections and its impact on price, you have to find out, point one, what is the price movement between the last general and this general election. Last general election, on the day when the election results were announced, we were at 7,730 odd Nifty. Today we are at 10,600. This 4.5-year movement so far is not a phenomenal large rally on the headline number itself, and on stocks also there has been not too much of froth. So between the last 4.5 years to this period, there's not been too much of a growth. But if you compare the same period from 2004 to 2009, the movement was very, very high in the first 3 years. So point is, general election is important, but the good news is last 4.5 years has not given stupendous equity return like it has in other pockets of periods between the general elections.
Right. Feroze, debt market, I mean, this was a surprise that sprung out of nowhere. I know there were a bunch of headlines, at least in the international media, which was calling the IL&FS default a repeat of Lehman. I mean, of course, IL&FS is a far cry from what happened with Lehman 10 years ago. But were you caught by surprise? Has the sentiment there also taken a hit? Because, I mean, if companies like IL&FS are defaulting, the big question marks are going to be raised on credibility.
Correct. I think that's one thing which is a big disappointment on the debt side, and I'm personally very disappointed on two fronts. NBFCs not managing their liquidity very well, in the aspiration of making higher net interest margins. I think there has to be a balance between risk and return, which an NBFC should aspire. Return from a company perspective is profit. I think that's been compromised to a certain extent. Asset liability mismatches of this extent are not a very healthy sign. That means that you got carried away to create profits. Point two, I think rating agencies, I have been disappointed several times by rating agencies of giving mechanical movements of downgrades and upgrades. And I think on September 3rd, a 16-notch downgrade on ILFS is a proof enough that the work is not being done in an analog fashion. It has been done in a discrete fashion. In 5 years, I've had negligible faith on the credibility of these rating agencies giving outputs. Of course, it's a strong statement to make, because we analyzed defaulted companies and saw what was their rating a year back. It would surprise you, like a company like Amtech Auto, before it went default, it was AA for 3-4 years. So rating agencies have to have a large responsibility, because rating is what is being marketed to an investor when he is buying. So that's surely something which we need to learn and implement, saying that my research is going to go significantly beyond rating agencies, and there are mechanisms to do so. Altman Z-score is one mechanism, just to give a name to and curiosity to the viewer. Altman Z-score has always been a better predictor of a credit default. I think that's what needs to be tracked more than ratings, in my opinion.
So Feroze, then what is it that one needs to look at? I mean, for a retail investor who has access to very little in terms of awareness, knowledge, ratings or credibility, if rating agencies, and this is not the first time, right? This has happened historically in the past, where rating agencies have failed to, of course, identify an issue that could come up in a few months. So maybe they're not being able to do their job with complete justice. But what are the other measures of evaluating whether a certain paper is attractive enough? And also, what is the advice you're giving your viewers when it comes to investing in debt markets? What sort of expectations should one have? What kind of paper should one look at for the next 1 to 2 years? How attractive is that universe?
See, I think debt is very attractive. Sometimes in the debt side, if I have to give pointed recommendation, credit risk funds have a lower risk sometimes than even a AAA rate fund, because everybody is in a AAA rated fund. As a fund manager, I'm buying that paper because market is buying it. But in a credit risk fund, the kind of detailed analysis which actually goes in terms of specifics, specific constituents of the balance sheet being analyzed and the deal being analyzed by the fund manager is far more, because he does not have a very strong rating. So you're going into not just rating, but you're going into nitty-gritty. So the disappointment is that these AAA rated papers were not a part of credit risk funds. They were a part of liquid funds in certain cases and short-term funds for the credibility they carried, and didn't even get the higher interest rate for the risk you carried. Because if I buy a bad paper or at least a low rated paper, I get a 2% extra return than a AAA rated paper. You didn't even get the 2% extra return. The homework was not done by the fund manager as much as it should be done. In case of ratings being low, the fund manager does more homework, which is a safer situation to be in. So we continue to recommend credit risk funds. Smaller size credit risk funds are a good mechanism with tried and trusted asset management companies like Franklin Santosh Kamath, who has been the CIO of debt and has done this for years, almost 8-9 years now, and has proved extra return it can be accumulated. Even if there are 1-2 slips in the journey, you still have accumulated 2%, 2.5% more every year to create a provision for 1 or 2 NPAs in a period of 4-5 years. So that's one thing which we recommend. So Franklin India Income Opportunities, just to give some pointed recommendation to the viewer, could be a good fund to add, because interest rates are high and even the spreads are high, so you're getting a good yield even after the cost of management.
Well, on that note, we'll take a quick commercial break. If you stay with us, we'll come back and continue our conversation, so stay tuned. one thing that seems to be reaching, or at least is a start to the end, is those banking crises that the system was grappling with. In a lot of whole bunch of NCLT cases, the government is taking things in their control. They're looking at capital infusion to PSU banks. I mean, that of course is unprecedented as well, which we saw take place in this year.
Yes, Samina. Of course, I think banking, has taken a beating. Of course, it had several under the carpet problems which have been unearthed. And I think that cleansing activity, which required cleansing for the last 5-10 years, in my opinion, largely 4-5 years, there was a lot of cleansing needed. I think that will take its due course of unfolding. So banking as a sector has always been a volatile sector. To put some numbers in perspective, it is at least 60% more volatile than Nifty is. So the movement on a bank index, Nifty bank index, is 60-65% more than on Nifty. I think that will continue. And I think banking as a sector has to be touched upon. From a fund manager's perspective, I'm sure they're doing their homework. If you're buying stocks yourself, banking as a sector infuses a large portion of volatility in your overall portfolio. So you have to make sure that you're being very wise when you're choosing a sector of that kind of leverage inherent because of the business nature they adopt.
Feroze, I remember the start of this year when things were looking up for us, and then the budget came along, and then we saw a big sell-off in the markets. Of course, it tied in beautifully well with what happened internationally, but back home, the return of long-term capital gains is what impacted a whole bunch of investors. Most of us spend a lot of time trying to understand the implications of it because things were not very clear upfront. This again came in as a surprise, right? And has changed the way we look at equity markets now, hasn't it?
Yes, I think fortunately or unfortunately, there are not too many gains in this year after the capital gain. And even if the grandfathered, there was a clause there, just for the benefit of the viewers, that the lock-in, your tax implication of your current investments are only beyond what was recorded level of January 31st. So most of the portfolios are lower than that. So currently there's no tax implication. But I think 1 or 2 points there to highlight is a person should wait till that same level is established so that he doesn't pay tax on the bounce back. If the investment is meritorious, hold it till it goes back to the value of January 31st is one action. If the let's assume a mutual fund has come down from 100 to 90. When it goes back and you don't make any change in that mutual fund, from the 90 it goes back to 100, then you don't pay any tax because the 100 level is grandfathered, is locked in, beyond which is what you have to pay tax. But if you sell this at 90 and buy another fund, then you have to pay tax on this extra 10 rupees, which you will not pay in the first case. So churning the portfolios might not be a very good idea till you re-establish the same levels from a taxation standpoint. That's one thing people are missing out and making changes without keeping this item in mind. So I think that's one thing which needs to be from a prospective basis rather than just analyzing what came in. Point 2, of course, a 10% tax on equity is not a very large dent, but if your expected returns were 15%, now they come down to 13.5%. So in the next 20 years, you lose equal to your capital because of this differential, or more than your capital in the next 20 years. So that's a large dent in the long term, and I think that can't be brushed aside. And the fear is that this is just the beginning. I think debt and equity in taxation will converge like most other emerged countries have little difference between equity and debt.
About mutual funds now. So let's move on from asset classes to vehicles. Even the mutual fund industry has gone through quite a bit of changes in the last 1 year, right? But before we go into that, I know the regulator, SEBI, brokerages, wealth management outfits like yourself, mutual funds, have spent a lot of time and money on financial inclusion and, of course, encouraging investments into financial assets. How has that been? Have AUMs of the mutual fund industry actually gone up in this last 1 year? Because equity markets have gone down, and on the face of it, it seems like most people would be selling out. But that's actually not what's happened in reality, right? Because your SIPs have been multiplying.
Yeah, I think SIP numbers have gone up to almost 7,700, 7,900 crores. They change a little. But to my mind, we have more sensible participants this time around, unlike the last time. I think there is a stark paradigm shift in terms of the thought process of the participants, especially domestic participant, retail participants. When you interact with people, which is what we do for a living, and then you get a sense of what is the kind of quality of conversation which was there 5 years back and today. I think people are far more sensible when it comes to long-term investing, and they know when an expert tells them that equity is good for the long run. It is told because of days like a few days like the last 1 or 2 months where you have seen volatility. That's precisely the reason why you're told that you have to wait for the long term. So that's I think is well understood. That's why there is rationality prevailing. Today the mutual fund industry also probably sends you an SMS when you redeem a mutual fund, trying to tell you that let's be not emotional and keep the long-term story intact. I think there is a lot of effort which has happened. I think when it comes to regulation, I would definitely like to highlight one thing, which for the lack of time, every fund manager, every investor should focus on one or at least spend some attention on one category which has been carved out in the mutual fund categorization circular. In fact, in the last Diwali, this happened. That's called focused equity funds. Focused equity funds, to my mind, could be a very, very good replacement to PMSs. Because I have been a strong contender of mutual funds. I propose mutual funds vis-a-vis PMS. I think now if concentration is your objective and if you're buying PMSs, to my mind, I think I would definitely prefer a more transparent platform, a lower commission product. Of course, that's why PMSs get pushed extensively because of the upfronting of commission, which does not exist in mutual funds. Focused equity has about 15 funds. There you get the most high conviction bets of the best top fund managers. So the risk is marginally more, but I think that's one thing which I'm very charged up about in the categorization on the equity funds.
Feroze, recategorization, I think that was also a pretty big exercise that the regulator ran. Up until now, definitions, names of funds were considered deceiving. There was a lot of multiplication in terms of, what various funds of the same, or rather various funds were carrying in their portfolio. With the recategorization of mutual funds, has it got better and easier for an investor to make a choice?
Yeah, I think from an investor standpoint, recategorization has still not played out its due course. To my mind, it will take a little while. Initial part is more confusing because the names of the schemes have changed. Their benchmarks are changing. So it will take some time to settle down. So from a client perspective, the simplicity aspiration is not delivered yet. But it will get delivered. That's the hope, because the direction is right. It takes time for people to get acclimatized to the new environment. Point one. When it comes to investor benefit, of course, I think there has been a large benefit in terms of keeping at bay the vested interest advice which was being delivered, not just by independent financial advisors, but large banking institutions, for example, who are the largest distributors of mutual funds. There was such rampant mis-selling. Okay, I'm being very strong in saying that, because asset management companies also supported and encouraged by their commission structures a large churn in people's portfolio. They used asset management companies innovatively identified a new nomenclature which was called trail being paid upfront. So the commissions were skewed towards the first year for the large banks in this country, and because 40% of the business was coming from banking setup and skewed towards 5-7 banks. So one big benefit for the investor is vested interest advice of churn is now not promoted by the cost structure or the commission structure, and I hope that AMCs don't innovate on that side again and create a Pandora's box of mis-selling possibilities for their distributors.
With that, we're completely out of time. Thanks for joining in, and thanks for watching.